Welcome to This Explainer. Today, we're unpacking exactly how Otis Worldwide is navigating a pretty complex macroeconomic landscape. We're going to do this by looking straight at their Q2 2026 earnings report and breaking down the numbers. If you want to understand how a massive global industrial giant balances explosive growth in one area with some very real headwinds in another, you are absolutely in the right place.
Here's our roadmap for today. We'll start with Q2 at a glance, then hit the service growth engine, new equipment and margins, cash flow and capital, and finally wrap up with the 2026 outlook. Let's get right into it.
Part 1. Q2 2026 at a glance. We're going to start with a high-level view of the quarter's financial performance, just to set the stage here.
Otis anchored this quarter with a massively impressive $3.9 billion in net sales. To put that into perspective, that is a solid 7% jump from the prior year. And honestly, even if we strip out the helpful little bumps from currency fluctuations and acquisitions, their true organic sales still up 6%. I mean, that is a ton of top-line revenue flowing through the business right now. And as CEO Judy Marks pointed out, this top-line triumph was largely driven by their service sector. She highlighted that their strategy, the specific actions they're taking, and their investments in service quality are getting serious traction. It's a really great reminder that there's a real human strategy and boots-on-the-ground operational execution driving these massive billion-dollar figures. Now, if we break down the raw numbers, the GAAP results show both net sales and operating profit are up. Earnings per share actually shot up 13% to $1.12. But, and this is a big but, when we shift focus to the adjusted, non-GAAP comparisons, we start to see some early signs of pressure. Adjusted operating profit actually dropped by $25 million, and the adjusted operating profit margin shrank by 180 basis points, basically a drop of 1.8%, falling from 17% down to 15.2% for the quarter.
So this brings us to the absolute central theme of today's explainer, the crucial tension here. Yes, top-line sales are definitively up, which is great. But what on earth is happening to the profit margins? Why is the adjusted operating profit feeling the squeeze while revenue climbs? Well, to answer that, we kind of have to split the business right down the middle.
Which brings us to Part 2, the service growth engine. Let's look at the booming side of the business, the first half of our tale of two segments.
You know, the service segment is an absolute growth engine right now. I mean, organic sales growth for modernization hit a staggering 24%. Overall, organic service sales were up 9%, matching the highest growth level they've seen since the company spun off. And foundational maintenance and repair? Up a very healthy 6%. Basically, they're seeing incredible demand driven by this aging global installed base of elevators and escalators that desperately need upgrading and upkeep. It's literally the classic razor and razor blade business model. Selling the new elevator is really just day one. Maintaining and servicing the millions of elevators that people ride every single day, that is the true cash cow over the long haul.
But here's the catch. The real story is hiding in the margin data. In the service segment, net sales hit nearly $2.6 billion, and operating profit went up by $21 million. But despite higher volumes and favorable pricing, the profit margin still contracted down to 23.2%. Why? Well, it turns out that higher labor costs, material cost headwinds, and what they call an unfavorable product mix, meaning they're selling more lower margin items right now compared to high margin ones, all of that is quietly eating into the profitability of these surging sales.
So, moving on to Part 3, new equipment and margins. If service is booming but margins are tight, what exactly is happening on the other side of the house?
This right here perfectly captures our tale of two segments, because while the service business is surging by 9% organically, new equipment is actually shrinking by 1%. Total net sales for new equipment were basically completely flat at roughly $1.3 billion.
And if we look at the geographic breakdown, it tells us exactly where the friction is coming from. The new equipment segment is stabilizing in some areas, sure, but it is severely challenged in others. The Americas are actually a bright spot, up roughly 10%. Asia-Pacific is up low single digits, but EMEA, Europe, Middle East, and Africa, is down mid-single digits. And the biggest weight dragging everything down? The Chinese market. They saw a high teens decline in organic sales for new equipment, which really just reflects the broader macroeconomic cooling and construction slump happening over there. So the takeaway here is that company-wide profit margins are being squeezed by some very specific, identifiable headwinds. We've got lower volume and unfavorable pricing in new equipment mixed with higher labor and material costs everywhere. But, and this is absolutely crucial to understand, not all of this margin contraction is an accident. Otis is deliberately directing funds in what they call service excellence. They actually expanded investments this year to capitalize on that massive modernization demand we talked about, to build long-term pricing capabilities, and to roll out new digital tools. So they are intentionally taking a short-term hit on margins for long-term operational dominance.
All right, part 4, cash flow and capital. Because at the end of the day, all those strategic investments require cold, hard cash.
Grounding ourselves in the actual cash flow data, we can see that despite all those margin pressures we just went through, the operational engine here is highly resilient. Cash flow from operations came in at $267 million for the quarter. That's a $52 million bump from the prior year. And check out the adjusted free cash flow, $290 million, up a very solid $47 million from Q2 of last year.
Now, when a company generates that kind of cash, the immediate question is, how are they deploying it? Well, Otis showcased some seriously disciplined capital deployment this quarter. That $290 million in adjusted free cash flow, which again is a 19% increase, allowed them to confidently buy back roughly $400 million in shares. On top of that, they bumped up their dividend by 5%, and they made a strategic acquisition by buying We Maintain, which further expands their service footprint. They're generating cash and immediately putting it right to work for shareholders and future growth.
Finally, part 5, the 2026 outlook. Let's see how these contrasting segments shape their expectations for the rest of the year. Looking ahead, Otis is clearly banking heavily on the durability of its service-led growth model. They're projecting total net sales to land somewhere between $15.1 and $15.3 billion. And notice that split again. They fully expect organic service sales to be up mid to high single digits. They're actively relying on that to buoy the company against organic new equipment sales, which they expect to be down low single digits to flat. But even with that top-line balancing act, they still expect to generate a massive $1.5 to $1.55 billion in adjusted free cash flow by year's end, with adjusted earnings per share sitting between $4.01 and $4.05.
So what does this all mean? It leaves us with a totally fascinating tension to monitor in the coming quarters. We really do have a clear tale of two segments here. With macroeconomic challenges like the Chinese construction market slump still lingering, a massive question remains. Will Otis's aging installed base and their big strategic investments in service excellence actually be enough to protect their profit margins and sustain long-term growth? It is the ultimate test of relying on recurring service revenue to weather a cyclical equipment downturn. Thanks so much for joining me for this explainer, and we'll definitely be watching to see how this strategy plays out for Otis in the months ahead.